Good morning, everyone. My name is Amanda Francis, and I'm one of the partners in the Buzzacott charity and not-for-profit team. Welcome to our webinar for charity accounts for non-accountants. As webinar attendees, your computer cameras and microphones are currently turned off. You will be able to communicate with us and ask questions at any point during the webinar via the Q&A chat function, which you should see and have available on the right-hand side of your screen at the top. We will be addressing as many questions as possible at the end of the event, but any questions that we don't have time to get to will be addressed in writing after the event. And after the event, we will send you those responses together with a copy of the slides. And this webinar is also being recorded, so you will have access to the recording also. In terms of your questions, in order to protect your privacy, all questions will be kept anonymous. The speakers today, the speaker at the end of the session will be Edward Finch. Eddie is a partner, again, in the charity and not-for-profit team, and Eddie will be addressing issues in respect to audit, those issues that have arisen because of COVID, but also some of the new auditing standards and the way that will impact the work that we as auditors carry out. Immediately prior to Eddie, Jamal Mia, who is a director in our team, will be addressing some of the accounting considerations that you need to be thinking about specifically because of the events of COVID-19. To start with, though, I'm going to begin with the Trustees report. And although it may sound rather strange to hear an accountant say this, my view is that the Trustees report is the most important part of your report and accounts document. And if we go on to the first slide, I say that because it is your opportunity to tell your story, the story of your charity, and the story of a year that probably has been like no other because of the impact of COVID-19. The Trustees report doesn't need to be simply a boring narrative document. Indeed, it should be something that excites, something that brings alive your charity to the people who will be reading it. And so one of the key things to think about is who will be reading our Trustees report. Who are your stakeholders? Many of you will find that your Trustees report will be read by your staff, by your beneficiaries, but many of you will also find that it's read by funders and people who may want to support your charity going forward. So it's an opportunity, as I say, to tell your story, not just through narrative, but by bringing it alive through photographs, case studies, statistics, and stories that really pull out the impact that your charity has had. It is above all about demonstrating good governance, which is something that is incredibly important at the moment and something that is focused on by the Charity Commission. And good governance in a time of a pandemic, such as that we've just lived through, is more important than ever. Ideally, what your report should do is explain why your charity exists, describe the work that it has done, and then the impact that it has had on the people that it has worked with and served over the course of the year. And then to talk about the impact that work has had on the finances of the charity, the way in which what has gone before has influenced your plans for the future, and also about how you govern and structure your charity, how your trustees liaise and talk with your management team, and so on. Through showing good governance, your report will explain that you've identified the effect of COVID-19 on your charity and on its work. You'll have identified the risks that have come to the fore because of the changes, and that you have had an action plan to address those risks. And that will give confidence to your staff, to your volunteers, but also to your beneficiaries and your funders. It will hopefully show that everything is under control. The report is also all about transparency, explaining to the reader and setting out the financial effect that COVID-19 and the events of the last year have had on your charity, not just now, but also the effect that it will have in the future, because that effect is going to go on for some time yet. In terms of thinking about the structure of your report, as I said, I would ensure that it is exciting by using photographs and quotes and so on. Think about the structure. Most people who read a trustee's report never get to the end. They read the first few pages. So think about what your key messaging is and make sure that that is said early in the report. Think about whether you want to have a chair's statement or a CEO's statement at the front to really pull out those things that you want to get across. And in terms of the timescale covered by the report, obviously you need to cover the period that is reflected by the accounts, but you need to think ahead as well, particularly in terms of your finances, and conveying the point that you believe that your charity is a going concern. And so in terms of your financial position going forward and your future plans, I would suggest that you look really in the short to medium term, certainly for the next 12 months, and 12 months really from the date on which you sign your trustees report. So if we go on to the next slide, I think COVID-19 obviously has been a massive challenge for many people. But as I've said on this slide, out of adversity comes opportunity. And I think the opportunity that COVID-19 has presented for many of us is a time to reflect. Because if we reflect, in all honesty, many of us probably don't want the world to go back to how it was in February 2020. We want change to come about because of this. And what I would urge you to do when you sit down to write your trustees report that covers the period 2020 or 2021 is to think very carefully and to reflect on what you actually want to say. You will obviously want to talk about the effect that COVID-19 has had on your charity and on its work in the past. But you might also want to really pull out what you believe the lessons to be learned and the way in which your charity will change going forward. What will be the new normal for your charity and what will it look like in the years ahead? In terms of reflecting COVID-19 in your trustees report, it probably isn't appropriate anymore to have a specific section on COVID, because it will be all-encompassing in terms of the way you're describing your work. But as you do that, you will want to introduce the fact that COVID-19 exists, that it has happened, it's outside of your charity's control, that it's affected everybody in the world in terms of social and economic impact, and then talk about specifically the operational impact that it has had on your charity. Talk also about the financial impact, as I said a moment ago, not just in respect to the year that's just gone by, although some of you will have struggled, but talk about your finances going forward and your finances in the context also of those future exciting plans that you may have. So do think about the future implications for your charity. And as I said, it is this point in your report where you really want to be upbeat if you possibly can, and to talk about the opportunities that you see ahead. All of that will be in the review of activities and the future plans, but there will be other sections of the report that will also need to refer to COVID. Those sections may include your risk management section and also your reserves policy. So let's start to unpick just a couple of those areas. So if we move on to the area that looks at your operational impact on the next slide. So this is where you tell your story, the story of your charity and COVID-19. Think about how you describe the impact that it has had on the demand and delivery of your charity's work over the past year, but also in the future. So, for example, have some of your projects had to be postponed or stopped? What has been the impact of lockdown on your charity and the logistics of actually carrying out your work? So if you're an independent school, for example, your teachers will have had to get used to teaching from their own home. If you are a care charity or a social care charity, you will have had to get used to working with PPE, to probably working very long hours, in many ways replacing your residents' family who were unable to visit them. If you are a religious charity, you may well have had your churches closed, and you may well have had to stream your church services and so on. Regardless, many of you will have had to close your offices, and that may well have impacted on your direct interaction with your beneficiaries and the services that you've provided. Some services may have been shelved, but others may have been given greater priority. There will have been, no doubt, an impact on your staff, your members and your volunteers. People will have worked from home. Some of your staff may well have been furloughed. Some may even have been made redundant if you have had to restructure in order to enable you to carry out your work or manage your finances. Think also about the impact on your beneficiaries. Some of your beneficiaries may have been given priority. You may have reached new beneficiaries because you may have reached them digitally rather than face to face. And there will also almost certainly have been some form of impact on finances for nearly every charity in this country. Those that will have suffered greatly will include those that have been dependent in the past on fundraised income and on funders. So fundraising events basically have essentially been cancelled over the last 12 months. And many funders have changed their priorities in terms of who they wish to fund, giving their funding to those who really are on the front line over this pandemic. So bring alive the impact that it has had on your charity, the steps that you have taken to address the uncertainties, how the situation has been managed and continues to be managed, and what the future implications for your charity may be. And thinking about the future, think about whether there will be changes to your property needs and your infrastructure. Will staff continue to work at home? Will you have a hybrid way of working? So some staff in the office, some work at home. Will there be new ways of delivering your services? Has this sort of medium, such as Microsoft Teams and Zoom, enabled you to reach a far greater beneficiary audience? And will that continue with a new focus and new opportunities? And will that mean that there needs to be future investment? Though more money invested in IT or in different ways of working, and will those bring with them new risks that need to be addressed and thought about? In terms of describing the financial impact, let me just show you the next slide, sorry, I'm moving on too quickly. But you probably won't be able to see this on your screen, but you will see it in the packs that we'll send you afterwards. I've just given you a couple of examples. I've taken this from an independent school, so it may not be relevant for all of you, but it just gives you an example of the way in which this particular school has explained the impact of COVID and really introduced the reader to the impact it's had. Now, moving on to the next slide, the financial impact. There will have been some form of financial impact for many of you, particularly on your income and expenditure. Your income may traditionally be grants receivable, and some of those grants may well have been received, but others may have been deferred, either because you've had to defer projects or because the funder has suddenly had different priorities. Those of you that rely on your investment portfolio to generate investment income will have seen almost certainly a dip in your investment income as the corporate sector has struggled to come to terms with the pandemic and has reduced its dividend payments. Some of you will receive income from rental properties. Again, your tenants may well have struggled to pay their rent, and you may well have given them holidays or deferred, again, those rental income receipts coming in. I've already mentioned that those of you dependent upon fundraising will have seen events cancelled, and your fundraising income and your donations almost certainly will have dropped. Some of you charge fees for entry, fees for services, and that admission or those services may well have had to be closed, and so this element of your income may well have dropped significantly. On the other side, some of you will have received money from the government in terms of furlough receipts and other grants and payments. However, most charities will have seen their income drop year on year, and that will obviously have had an impact on the way in which you've coped with your services, either by dipping into reserves or by necessarily prioritising and working only with those that are key. On the expenditure side, some of your expenditure will not have been possible to cut. Staff costs, for example, will have continued, albeit that you may well have been able to fund some of them through the furlough scheme. Projects will have been deferred and hence expenditure not incurred. And those of you that make grants may well have found that the number of applications you've received has increased quite dramatically, and therefore some of you may well have increased your expenditure to meet the demand of the beneficiaries that your charity has. In terms of your assets and liabilities, those with investment portfolios will have watched in horror at the end of March last year as your investment values plummeted. But most of them will have come back, and by the end of December probably were where they were prior to COVID. But there will be considerations in respect to your property, and in your report of your trustees you need to explain how you've managed that. So the liaison you've had with your investment managers, the way you've continued to ask them for advice during the period. Cash flow is something that your report does need to refer to, because it is always, cash is king for many charities, and I'm sure Eddie will make that point as he talks about going concern. But think about how you describe the impact of deficits in the year on your cash flow and how that might affect your future plans going forward. And it may well have affected your reserves policy in terms of designated funds and the money that you've set aside. You may not be reaching your reserves policy at the moment. And that may lead you to talk about the overall financial sustainability of your charity and its going concern, particularly in the light of those future plans. To continue with my example on the next slide, this is really just a continuation of that independent school and describing some of the impact financially on them because of COVID and the enforced lockdown and closure of the school. So the need to give discounts to the parents, the fact that certain of their income, for example, from buses and catering simply did not come in, the fact that they gave salary increases weren't possible, and so on. And you'll see in this particular case, they've addressed the two key closure periods for schools, both in 2020 and 2021. And it just gives you a feel for the type of detail and the type of explanation that's needed. And as I said earlier, your report isn't just focused on COVID in terms of your review of the year and your finances, but COVID will impact on the way you address other aspects in your report. So on the next slide, just a few of the reminders of the other areas in the report that you may well need to consider. Your reserves policy, I think, is absolutely key. This may well be a year where you've had a significant deficit, and that may well have had quite a detrimental impact on your reserves. You therefore need to be thinking about whether your reserves policy is still appropriate, and if it is, explaining why it's appropriate. You may not be meeting it at the moment, but explaining how going forward, the changes that you're going to make, the opportunities that arise, enable your financial position to recover so that you can again meet that reserves policy. And it may well be that if you have new investment plans, new ways of focusing your work, that your reserves policy again needs to reflect those particular ambitions and changes. Risks over the past year will have changed. And the section on the risk management within your report is absolutely key, particularly to demonstrating good governance, because it highlights to the reader that your trustees have thought about what can go wrong with our charity and what should we be doing to mitigate those risks. So typically within your report, you will refer to 3 or 4 of the key big picture risks. And those big picture risks may well have changed because of COVID. So think about what those risks are, how you describe them, and how they're mitigated. Again, some of the mitigating factors may well have changed because of the way in which the way we work has changed. So if you're now working from home, some of the controls may well be different to those that were operated when everyone was in the office. And finally, think about COVID in terms of your future plans. Where are you going once we start, as we hopefully are, to exit from this crisis? What effect does it have on the focus your charity will have on its work? And talk about the future plans, both in the context of what has gone before, but in the terms of where you are financially. And finally, just to bring you up to date with the example. So again, continuing the example from the independent school, this is just a way where they have just adapted or edited their key risks that they've addressed over the last year in terms of pulling out some of the ways in which the crisis and the COVID-19 has affected those risks. I will end by just saying that, repeating what I said right at the beginning, really, that I do think that this is an incredibly important part of your report and accounts. I think going forward, it is even more important given the situation we find ourselves in. You do need to ensure that you're addressing the right audience, that you are enthusing future funders, future beneficiaries, and making sure that you're pulling out the fact that life goes on and hopefully will be better in terms of as we exit this crisis to what it was before, and explaining how your charity and its vision has changed as a result. Now let me hand over now to Jamal, who's going to address some of the accounting considerations that you need to be thinking about, specifically again with COVID in mind. Jamal.
Thanks, Amanda. So last year, following the outbreak of COVID-19, we saw charity accounts containing additional disclosures to provide readers with the accounts with an understanding of how the pandemic had impacted or would impact the charity's finances. 1 year on, and for a lot of charities, the accounts will continue to look a little bit different to pre-COVID times. And in this part of the presentation, I'll aim to highlight some of those peculiarities to help with the preparation and interpretation of those accounts. To structure the session, I have grouped these peculiarities into 3 areas. Firstly, the accounting issues which arise due to the impact on the day-to-day activities undertaken by different charities. Secondly, the accounting issues arising due to uncertainties created by COVID-19 on the wider economic environment. And finally, the accounting considerations in relation to the various sources of external financial support which have been made available to charities. As time is limited, unfortunately, I won't be able to go through each and every eventuality which may arise, but the aim of this session is to highlight some of the more common issues and the accounting principles involved. The underlying accounting principles, driven by the requirements of the charities sought, remain unchanged and should therefore these principles can and should be applied consistently across similar circumstances. So if we move on to the first slide. So starting with the first of the 3 areas, there are of course charities that will have been more financially affected by the pandemic than others. And on the slide on your screen, I've highlighted some of the more significant considerations. For many charities involved in hosting in-person events, courses, or offering other client-facing services, the financial results will largely be influenced by the extent to which the charity has been able to continue its work and the extent to which events, courses, or similar have had to be cancelled or postponed. The underlying accounting principle is that the income should be recognised in the reporting period in which the course, event, or service is delivered. Many of the affected charities have been successful in converting face-to-face delivery models to online platforms, but where events or courses continue to be postponed, any cash received in advance should not be reported as part of the income until the service is delivered. Instead, the value of the cash received should be held on the balance sheet as a liability, recognising that the charity either owes the customer a service or a cash refund. With respect to cancelled courses or events, if, however, the fee payer has confirmed that they would be happy for the charity to retain the amount already paid across and no refund is needed, the cash received in effect becomes a donation and may be reported as donation income immediately. Many charities fund their work through the receipt of grants and donations. In some instances, the use of the grant will be restricted to a specific project or purpose. This may be, for example, the completion of a specific piece of research, or say the construction of a building in a developing country. Such income would ordinarily have been recorded as restricted income, but there are a few additional considerations here. Does the project remain feasible? Has the project been delayed or significantly altered? Was the project dependent upon a certain level of funding being achieved? Where it is clear that the charity may not be able to complete the project in the foreseeable future, or that the donation cannot be used in the exact way that the donor had intended, a decision needs to be made as to whether the grant funding received should be reported as part of the charity's income, or instead included as a liability in recognition of the fact that the funding received may need to be returned. To help make this judgment, affected charities should be having conversations with their funders to determine whether it is possible to change how the grant is being used or change the timing by which the money needs to be spent. For charities that are on the other side of the fence and principally involved in awarding grants to other charitable organisations, the situation needs to be reviewed from the opposite angle. With regards to grants already committed, it may be that the recipient charity is no longer able to accept the funding, for example, if it has taken the decision to close down, or if there's insufficient capacity or resource to be able to deliver on the original project. If it becomes apparent that the award should be withdrawn, then the charity should remove any commitment from the accounts previously recognised within creditors. If the cash had already been transferred to the recipient and the charity is not happy for the recipient to retain the cash for other purposes, a debtor should be recognised for the cash to be recovered. Some not-for-profit organisations depend on income from charity shops, or, for example, carry out trading activities through gift shops. With the government-imposed closure of retail outlets, income will, of course, likely be reduced within your latest accounts, but there may be other considerations in terms of the stock value. If the shop was closed due to lockdown at the balance sheet date, this will, of course, make it a lot easier to count the stock, but consideration needs to be given around whether any provision or write-offs need to be made for slow-moving or obsolete stock items, for example, perishable confectionery, out-of-date calendars, or similar. The other quick point to make about retail outlets is that they may have received a business rates discount. The value of the discount should not be reported as part of income, but left as a reduction of the rates expenditure. So on the next slide, in the context of the wider economic environment, the key challenge for charities presented by the pandemic is around future uncertainties. And it is the charity's assessment of those uncertainties that will influence some of the judgments made around the carrying value of assets and liabilities reported on the balance sheet. On this slide, I've set out a few examples of assets and liabilities which may need additional consideration in the year-end accounts. Charities with investment properties are required to carry such assets on the balance sheet at its fair value or market value at the year-end date. Last year, following the outbreak of COVID-19, the Royal Institute of Chartered Surveyors advised that any professional valuations offered by RICS registered firms should be issued with the caveat that the circumstances created by the pandemic means that the valuation is subject to material uncertainty. By September 2020, however, RICS have since noted that there has been sufficient evidence of market activity to allow the material uncertainty caveat to be lifted from most valuations. The trustees of the charity do, of course, need to reach their own conclusions regarding the fair value of their investment properties and whether an adjustment to the carrying value may be required. The other point to just bear in mind here is around rent waivers. It may not be appropriate for charities to offer rent waivers to commercial businesses occupying their property, particularly if such an offer may not be in the best interest of the charity. Where such a situation arises, it might be helpful to get steer from your legal advisors or auditors. Charities with other functional fixed assets, including property, fixtures and fittings, office equipment, and etc., should also give consideration as to whether the values of such assets may be impaired. That is to say, the economic benefit or the service potential which can be drawn from the ownership of such assets may now be significantly diminished. This may, for example, be relevant if the charity feels that the level of activity delivered using such assets may not recover to pre-pandemic levels, or if there is no longer a need for certain assets. Many charities are currently considering their office space requirements, and downscaling in the short term could lead to the early disposal of associated assets such as furniture and equipment. A connected consideration for charities that are looking to exit property leases early is in relation to the potential cost of reinstating the property before returning the keys to the landlord. Charities should review the terms of their lease and ensure that a liability is recorded for the potential reinstatement cost if this is called for by the lease agreement. The pandemic has unfortunately placed financial strains on many businesses, charities, and individuals. And one area of the balance sheet that may therefore need additional attention is the likelihood of recovering debts. Where there is a doubt or clear evidence that the debtor will be unable to settle its debt with the charity, there may be a need to reduce the debt value through write-offs or provisions. Another consideration for charities which employ a lot of staff is in relation to holiday pay accruals. The reporting standard requires charities to consider the amount of outstanding holiday entitlement held by their employees at the balance sheet date and to determine whether a liability should be established for the value of the holiday owed but not taken. Many charities which have not previously made such an adjustment on the grounds that the value would be immaterial should reassess whether this remains the case, particularly if more staff are not using their holiday entitlement or carrying their entitlement forward into future years. And the final slide from me covers the accounting considerations in relation to external COVID-19 financial support. So some charities will have taken advantage of the government's coronavirus job retention scheme and recovered government funding for employees placed on furlough. A question which is often asked is whether such income should be netted off against the staff cost in the accounts or whether the income should be shown separately to the expenditure. The correct treatment is to keep the income separate to the expenditure, and in particular, the income should be classified as part of unrestricted income. The income should, of course, be reported in the same month as the relevant employees were placed on furlough. And in terms of the associated staff cost expenditure, the cost should be presented in the accounts as per the usual analysis, even if the employees had been placed on furlough, i.e. to the same analysis for activities. Some charities may also have successfully applied for a bounce back loan or indeed obtained other external debt finance in order to support their longer term recovery. In addition to reporting the outstanding liability within creditors on the balance sheet, the notes to the account should provide a clear narrative explaining the key terms of the loan, the rate of interest that will be applied, and the anticipated timing of repayment. Some charities may also have been able to negotiate temporary rent concessions with their landlord. Where the charity has been offered a rent deferral, but the usual rent remains payable, the full rent is still recorded as expenditure in the period of occupancy, but a creditor is included on the balance sheet until the rent payment is settled. Where the charity has been offered a temporary reduction in rent, then the rental expenditure is simply reduced in the period in which the reduced rent offer applies. This temporary arrangement in response to COVID-19, however, is different to a rent-free period offered by landlords as an incentive to take on a new lease. The value of the benefit of the rent-free period in such circumstances should continue to be spread evenly over the term of the lease, as was previously the case. The final item on this slide, we discussed earlier the impact of COVID-19 on grant-making entities, but really just to stress that each and every grant received will carry with it different terms and conditions, and it's important that those terms and conditions are reviewed and understood to help determine the correct presentation in the accounts. So that's everything from me. As I say, unfortunately, we don't have the time to cover each and every eventuality, but hopefully that offers a little bit of food for thought as to where there may be accounting issues that require further consideration or discussion with the auditor. And with that, I'll now hand over to Eddie for a discussion on the audit issues.
Thank you, Jamal. My lips moved before the sound came then. What I'd like to look at is just a few things. For most of you, almost by definition now, if we're doing an audit under slightly odd circumstances, it'll be the second one, or if your auditor, if you're not one of our clients, is doing an audit, it'll be the second one that's been done under odd circumstances. But just a reminder of some of the things that are a bit different about having to possibly work remotely, and the constraints it puts on the audit, and the things we might not be able to do the same way as we've done in the past. Secondly, I'd like to look at the specific issue of looking at going concern in the context of massively greater uncertainty than we normally have. And again, that might be a second time round, but many of the discussions we had last year were on the basis that we think, given the reliefs and the reserves, etc., we can get through this year, but next year might be tricky, and we've got to next year now, so we'll have different conversations perhaps this year. And then finally, just from a trustee's perspective, just to let you know that there are a couple of things that might be going on in the audit that are a little different from previous years, because we've had quite a few changes in the underlying audit requirements. So to move on to the first slide, to look at those things that are a bit different. Oh no, that's a bit different, isn't it? So sorry, this is just to frame why things might be a bit different. So this is a little, those of you who've been auditors or accountants will have sort of seen all of this during your training, but this is really looking at the different things that auditors have to satisfy themselves about in relation to the things that go into accounts. And there are sort of three places that we look. There's your income and expenditure, which is transactions and events. There's your balance sheet, which is your assets and your liabilities. And there's the overall way that things are presented. Many of those things we can look at in a perfectly ordinary way remotely. So particularly where we're looking at things like occurrence, whether something actually happened, where we're looking at existence, we may have more issues satisfying ourselves around those things if we're not able to come and see you. But for example, as well, completeness. So if we're wanting to look at the completeness of your income and you keep a booking record, for example, it might be more difficult to assess things. Whereas other things like whether numbers are accurate and whether we can agree things back to records and bits of paper, we can do by you showing us things online or by us getting copies sent to us, for example. So that was really just for those of you who have got any sort of background in audit and accounting, fixing where our difficulties come from in relation to the sort of background to audit. But to go on to the specifics on the next slide. So as I've just said, really, some parts of audit work very well remotely. We can access a lot of accounting systems ourselves remotely if we're given the right logins. A lot of you keep your transaction records, things like invoices, digitally anyway these days and linked to your accounting systems. Where you don't, things become trickier. But where we need to look at underlying paperwork, particularly, like I say, for testing completeness, it can get trickier. If you have been able to open your shops during the year, you tend to have big boxes of till rolls stuck in rooms somewhere, which are much more difficult to access at times like this. when we're looking at issues like whether you might have liabilities as a result of legal proceedings, etc., getting hold of correspondence files and looking through them to make sure everything in them has been taken account of is more difficult. Things like stock, going and seeing that the stock actually physically exists at the end of the year, looking at any new fixed assets. I mean, we can take some comfort with a lot of fixed assets that they were there the previous year, and we can only do that for so many years in a row. And as I say, it's the second year, but particularly if you've had any new fixed assets in the year, it's difficult for us to check that those are really there. And also having access to staff, and particularly it's quite easy maybe to schedule a regular catch up with somebody in finance throughout the audit, but those sort of little visits around the office to talk to people who deal with different things in the operational teams are a bit trickier. And obviously where people are put on furlough, there are specific reasons why they're not supposed to be maybe working under the arrangements of the furlough. So just really to flag up that there needs to be a bit of flexibility in terms of timing sometimes and the approach, and that the things that we're able to look at might be a little bit different from normal audits. And the last thing I've just flagged up there on that bottom point, comparability issues, and this is one that probably will flummox you as trustees as much as it will complicate our lives. One of the first things an auditor will do in terms of auditing a set of accounts is look and see whether the numbers look broadly as they might have expected them to. That might be that they would expect them to look very different because we know there have been changes in the business, but ordinarily the first assumption we'd make is that years would be a sort of relatively gradual progression one on the next. And of course this last year all of the numbers will be, or many of the numbers will be likely to be quite different. So that in itself will mean that there'll be different risks that we'll need to audit against and different conversations we'll need to have with you. So that was a look at just really something that will be more of the same for many of you, that the changes in the audit will be the same as happened last time. We've all just got better at doing them, I suspect. Moving on to the next topic though, which is going concern. The first slide I've flagged up is there's a little box that's right at the front of the auditing standard that we have to follow in reviewing going concern, which tells us how to interpret this phrase going concern. And the general meaning of the term going concern is that an organisation is going to be able to carry on in business for the foreseeable future. But what this box tells us is that when we're preparing accounts, it's a very specific interpretation of that term going concern we're looking at. For legal reasons and for Companies Act, for Charities Act reasons, you're required to prepare your accounts on the assumption that you're a going concern unless, as it says in that box A there, or part A rather, unless you intend to cease trading or have got no realistic option but to do so. So actually, the decision about whether to prepare your accounts on a going concern basis isn't the real issue in discussing going concern. What we'll come on to on the next page is that it's really all around assessing, given that unless we're about to wind the organisation up, we will be preparing the accounts on a going concern basis. Are there any of these events or conditions that may cast significant doubt on the ability of the organisation to carry on doing that and preparing accounts on a going concern basis for the foreseeable future? And I think Amanda's already mentioned that a foreseeable future typically is at least a period of 1 year, but we're all encouraged to think a little bit further than that really, just at the moment, and whether there are things that might happen just further than the 1 year. So we have this new requirement on us to look at going concern in a slightly different way. In terms of what you're required to do, you need to make sure as trustees, as management, that you've seen enough information to persuade yourselves, firstly, that you should prepare the accounts on a going concern basis, which, as I say, should be a very easy decision. But secondly, to decide whether there are any of those events or circumstances you need to disclose about things that might cast doubt upon your ability to carry on as a going concern for at least a year from when you approve the accounts. And that would be things like your big income contracts coming to an end during the next year or so, there being obviously uncertainty around whether and when you can restart some of your activities if you rely on trading income or events, etc. And things like the level of reserves you've got to support you should things not turn out as you'd quite like them to. And what you're expected to do usually is to make that decision based on a review of your future financial circumstances, based on budgets and, as Amanda's highlighted, very importantly, cash flows, because it's all very well to be showing an accounting result that shows you're in surplus, but if you're not able to collect cash and pay your wages, etc., you wouldn't really be a going concern. But on the basis of seeing cash flows and projections for at least a year from when you're approving the accounts, do you believe that you can say that you are a going concern without significant uncertainty, or are there doubts that mean you should be making disclosures in your accounts? And what you'll be expected to do, looking at that right-hand side, there are some of the things that we're now required to do as a result of greater expectations on us as auditors. We're required to make more documentation in our files about how you assess the risk of going concern and how you monitor whether you are still a going concern. We're required to perhaps challenge a bit more robustly where